All right, so lately I've been talking to a lot of entrepreneurs at all different stages, from seed, Series A, Series B, growth stage, kind of across the space, spanning all different stages. And one of the things that I keep hearing being brought up and questions I keep asking is, when will the valuations get back to the heyday of 2021? I really kind of have bad news for those entrepreneurs. I don't think that the heyday of 2021 will ever come back. I think it was a confluence of a lot of different factors all hitting together at once. Today, I'm going to dive into some of the data that informs my perspective on this, and as well as talk about like how 21 actually occurred. Like, what were the things that drove valuations up so high and rounds so high, and kind of what was going on that created that situation. And then lastly, I'm going to wrap up with some advice for entrepreneurs that find themselves in this situation today, where they're running their company, they're seeing a potential recession, they're seeing valuations come down and it taking longer and longer and being harder and harder to raise money. And my advice on what they should be focused on today to make it through this and build a successful, enduring company. All right, so first of all, let's dive into some of the data. So first, let's talk about what was happening in 2021. It was a crazy time. Now, I've been a venture investor for the last 14 years. I started my career right at the height of the recession. In fact, I graduated from college in 2009 when there were barely any jobs. And that's right at the same time that I started working full-time in venture capital. I've seen ups and downs in the market over the last 14 years, but 2021 was like a whole other animal altogether. You know, for years, we had been waiting as an industry for the next recession, because recessions in general historically had been occurring every 5 to 6 years. And as year after year after year stacked on above those 5 to 6 years, we kept wondering, is there going to be another recession? When is it going to be? When is it going to start? And yet it didn't. And every single year, valuations just crept up a little bit more, a little bit more. And we kept thinking like, okay, now we are in a bubble. And yet the next year, things would grow just a little bit more. And that led us to 2020 and the COVID pandemic. Sorry, you probably all remember roughly where you were in March of 2020 when the stock market collapsed and everybody was freaking out about COVID. I remember where I was because I was at Disneyland. Probably not the smartest place to be during the height of COVID, but I didn't know it was coming, and I had a great time at Disneyland. But during that year, right, a bunch of companies started hunkering down, trying to conserve cash. Those that were running out of cash went out and raised emergency rounds of capital. We actually invested in a handful of companies that ended up being incredible investments for us. And, you know, it was a really interesting time, and the federal government moved very quickly and started spending a lot of money. The Fed, in addition, started printing a lot of money. And the idea was that as the economy slows down because everyone's staying at home, there needs to be more money in the system to help people cover their rent, cover their grocery bills, cover their utility bills, just basically survive until the vaccines could be rolled out and kind of the pandemic could be managed, if you will, right? Such that people could get back out to work. But what that did was you had a few things occurring. You had one, this long-term kind of gradual steady increase in valuations. You had an insane amount of money being pumped into the system. And you had a few different things occurring in 2020 that all led up to this like crazy year in 2021. So one, we had pretty much constant flow of funds into the system from the Fed. We had super low interest rates forever, and so it was never easier than 2020 and 2021 to get access to capital, whether it was for a mortgage or a credit card or even through stimulus packages from the federal government. So you had all this money flowing into the system, and that had really been happening over the last 10 plus years since the last recession. And then they just like spun it up to 11 basically by pushing tons of government stimulus as well as the Fed printing a ton of money. So all that happens in 2020 to help us all like manage our mortgages and our rent bills and so forth. 2021 rolls around and all of this money has to go somewhere. What happens is investors want to put that money in places where it's going to generate a return. And so they're chasing returns wherever it could be. And what they saw was that public markets, one, had performed fairly well, but really the real value creation was in venture, because you could invest in companies when they were doing $10 million in revenue at a relatively low valuation and help them grow to generating hundreds of millions of dollars in revenue, and then get a multiple of that in terms of valuation. And so you started to see a lot of different players start to enter into the venture capital space over the last few years. So hedge funds, which had traditionally only invested in the public space, started dabbling more and more and more and more earlier stage. Great example of this is Tiger Global. Over a decade had been focused on the public markets and now had started to spend a ton of time investing in the private markets. In fact, they were raising $10 billion plus funds to deploy into startups, and they were writing checks as quickly as 2 weeks. There are stories where they would call up an entrepreneur, they would hear the pitch, and by the end of the pitch, after an hour-long conversation, they would basically give them terms. Next day, give them a term sheet. 2 weeks later, fund them, and then invest 2 weeks later at a valuation that was very founder-friendly, which allowed these things to happen very quickly. In fact, most venture capitalists, myself included, we were working like crazy because companies would come in, they'd have incredible metrics because they were growing super fast, because they were spending a lot of money, and they'd be like, hey, we're going to close this round in the next 2 weeks. If you want in, you got to move quick, right? A lot of VCs were working around the clock to make sure that they could allocate funds into these deals. And so the deals became more competitive. And so all of those elements ended up hitting together, where you had venture funds and hedge funds and private equity funds and even mutual funds all competing for deals. They were raising monster funds, and then those funds had to be allocated into companies, and all of that money chasing a scarce number of high quality deals just pushed valuations through the roof. Okay, so that's how we got here. Now the question is, what happened since then? But here's the problem with all that money chasing deals. Eventually you're going to get inflation. Now inflation is basically an equation with two primary factors. One is how much money is in the money supply, and the other factor is what is the rate at which that money is trading hands. It's called the velocity of money. So one is the money supply, the other is the velocity of money. And you can have a lot of money in the money supply and not have inflation if people are taking that money and shoving it under their mattress. Or the other thing that could happen is there's a lot of money in the money supply, but that money is being invested and it's being held by different companies. It's being put into real estate and other things that are kind of long-term assets. And so the velocity of money doesn't really change. But what happened in 2021 and 2020 to a certain extent is all of a sudden these people were sitting on large amounts of cash, and they started spending it. They started spending it online. They started going, in 2021, they started going on vacations because they were so excited to get outside of their house again, right? And the velocity of money started to increase. And so you had tons of money being pumped into the money supply, and you had the velocity of money start to take off as investors were investing in lots of companies and consumers were buying lots of products. And that resulted in the environment today where we have very high inflation. And now the Fed is coming in and they're pulling back on the money supply. They're trying to pull money back out in an effort to reduce inflation. The problem with that, though, is that now everybody is freaked out that we're going to head into a recession. And the reason for that is that as the Fed pulls out money, there is less money to invest in things. There's a less ability for things to kind of grow and go up and to the right. And so as that money gets pulled out, companies just are going to end up slowing down. As that happens, that could end up pushing us into a recession. The other thing that happens is because there's so much uncertainty about inflation and a pending recession and all of those other things, venture capitalists and investors are starting to pull back. They're saying, okay, I do have quite a bit of cash that I could invest, but I need to make sure that my current portfolio companies have the money they need, especially the ones where I invested at really high valuations. And that is why it's taking much longer for companies to raise money and why valuations have come down quite a bit. Now, there are still some instances where companies are able to raise at a very high valuation, but those are more the exception than the rule. If you look at some of the data, so I pulled some data from PitchBook in their most recent 2022 second half valuation report for venture capital. What I thought was super interesting is you see these really flat trend lines where from 2012 to about 2020, the median amount raised for an early stage company was in the $10 to $20 million range. In 2021, it doubled to $40 million, right? Crazy, pretty flat and then pop. And you see this exact same trend happening in other stages and sectors. So enterprise software companies, they all pretty much doubled the amount of money that they are raising in 2021. Same thing with consumer products, didn't grow quite as much, more like 40-50%, but still a significant pop over where they were historically. What we're now seeing is that kind of across the board, those valuations are starting to drop. The amounts invested are starting to drop. The number of deals done are starting to drop as investors start to pull back. And my prediction is that what will happen is we'll get back down to that kind of more historical rate. So if you're an entrepreneur and you're in this situation, you're trying to figure out where you should be valuing your business and what you should do to set your company up for success in the long run, I would recommend you do a few things. One, look at valuations for your sector and for your stage of business back in 2018. That's probably a pretty good litmus test for where valuations will be kind of going forward. And maybe it's a little conservative, but it's going to be close. So look at valuations at that time frame. The other thing is, if you've raised money in 2021 at a very high valuation, I highly recommend, if you haven't done this already, to go back to your investors, potentially raise some additional capital at the last round or via a SAFE, to give yourself at least 18 to 24 months of runway, just in the event that we do head into a recession and capital becomes even more scarce. I know this isn't like super fun to talk about, but I think it's a super important thing to understand what's gone on in the economy, how it can impact your business, and the steps that you should be taking right now to make sure you survive and even thrive. Here is the silver lining to all of that. If you can survive the next 12 to 24 months, a lot of your competitors will likely get washed out, and you'll be in a very good position to take market share and grow and ultimately succeed. If this was helpful, check out some of my other videos where I talk about current events, such as how does the current public market collapse impact venture capital?